I'm Maria Horat with Gold Country Properties. I'm a real estate broker here in Northern California. And today I have Jodie Luke-Carter from Castle and Cooke Mortgage. And
Hi.
we're going to be talking about interest rates and the different programs that are out there available and some of the market trends and economy. So I hope someone finds this information useful. So anyway, so we have seen, Jodie, in the last year that the Feds have increased the interest rate by like 7 times, right? Since March of last year. I wanted to show you, can you see it? Screen?
I can't, it's a little small for me, but that's okay.
Let's see if I can just expand a little bit. There, is that any better?
Let me see. Let me put on my reading glasses. Let's see if I can see it better. No, I still can't see it.
Okay. So since March 17, up until December, they have increased 7 times.
Yep.
And of course, we have seen that the stock market basically went down anywhere from 20 to 30%, depending on what you're looking at. The S&P 500 closed at almost 20%, and the NASDAQ at 30%. Bitcoin collapsed. So we're seeing the Feds are trying to address the inflation rate, but it looks like there might be a little bit of a slowdown on inflation, but they are expected to increase it a few more times early this year, and then supposedly even cut a little bit then starting after May. That's what I'm seeing, in the news, and all the experts are talking about. What are your thoughts on that?
Yeah, so exactly what you have there. I was able to see it once I put my glasses on, but yeah, it has gone up. And in each one of those times, I mean, we knew that they were coming, right? They've announced them way ahead of time. So those have all been there. And then for this year, we don't have a set increase on right now, but we know that they may do it. It's all dependent on what inflation does and how the inflation is going to pan out over the next, few months. So recently, I've actually seen the rates going down a little bit. It's kind of like a roller coaster. So, we might go up a quarter point one day, and then we go down 0.375, and then we go up an eighth, and then we go up a quarter, and then we go down 3.75. So it's been a little bit of a roller coaster. So what I tell buyers is, but we are having those little dips, right? And we are slowly trending down, maybe like an eighth every week. After all the bumps up and down, the trend is a little bit down. So that's good. And the idea behind that is that we want to lock your rate if you're buying a house or you're under contract. We want to lock your rate on one of those days that are going down. Obviously, there's no way to predict it perfectly, but when we see that little trend, like yesterday it went up a little bit, but then today it went down about an eighth over what we went up. So then I locked a few loans today. So you just try to catch those down days right now, while we're kind of waiting out and getting to summer, because it may go up again at the beginning of this year, depending on how much they need to curb that. But by summer, we're expecting to see it kind of leveling out and dropping permanently. I don't think it'll be anything crazy, I think
that 2% interest are, far gone, but at least they can be kept under 6. But then again, it will all depend on the inflation and how that pans out too. So what kind of programs are out there? I know interest rates, obviously have made a huge difference on the mortgage payment. So if we look at, I was looking at the National Association of Realtors. Let me just see if I can get to that. Here we go. And I just wanted to take Tuolumne County as an example in California. The average mortgage payment a year ago was $1,244. Now it's $1,917. This is as of November, so it hasn't been updated. So basically about $672 higher than it was a year ago. And so you know, the incentive for someone to buy a home versus renting obviously depends on the payment. And rents are high also. So like a 3-bedroom, 2-bedroom in our area in Tuolumne County is right around the $1,800 to $2,000. So there's still, you know, an incentive to be a homeowner. At least you get the write-off for the mortgage and the tax write-off benefits. And but not so much the case for other counties. Like, for example, Alameda County. Oops. Let's take a look here. So now we're looking at 5,555 versus 3,586. That's quite a difference. I know the average, say 1,400 square feet home in Alameda rents for somewhere in the vicinity between 3,000 to 3,500. So basically, the incentive to buy a new home or for a first-time home buyer might be unattainable. And rents are still, you know, they're high, but they're still lower than that figure right there.
Right.
I guess it depends on what county you're looking at. So which makes it really nice for counties like Tuolumne County. Let's look at El Dorado County, for example. We see the difference also is substantial. If we look at Del Norte County, a year earlier, 887, it's kind of like Tuolumne County, 1,366. So that, you know, the rent around in the Del Norte County is about, it depends, but it can be closer to $2,000 for a 3-bedroom, 2-bath. So the incentive to be able to be a homeowner is still there instead of renting. So anyway, so I just wanted to also get, you know, your information on the mortgage programs that you have available for first-time home buyers and also for investors. Because there's people who can't buy a house, don't have the, you know, proof of income the traditional way, but, you know, have to go and show your, you know, your income and loss statements and all of that. So maybe you can...
Yeah, I can definitely talk on that. So obviously incentive to buy is going to be equity, you know, earning over time, paying yourself instead of, you know, somebody else's mortgage, right? But it still is harder. And there's a couple ways for buyers to make the payments more affordable. One is a rate buy down. I don't know if you've covered that, you know, on this before, like having the seller give you a credit.
Not. If we can talk about that, that'll be great.
Yeah, so I would say probably 80 to 90% of the loans I'm doing are called what's called a 2-1 buy down or a 1-1 buy down. And what that is traditionally in the past, maybe a buyer would offer, I'm going to offer $350 for your home, but I need $5,000 in closing costs, right? Oh, right? So sometimes buyers will ask for closing costs and we take that closing cost credit and we buy down the interest for 1 or 2 years. And so it really helps buyers kind of jump into the market. So let's say the rate is, you know, 6.25. So for year 1, it's 2% lower. So it's 4.25. And then year 2, it's 5.25. Year 3 through 30 is going to be 6.25. So it is a traditional 30-year fixed rate. All of the qualifications are the same. It's just that the seller is prepaying your interest. So it kind of helps you get in there, qualify, get that lower rate for those first 2 years, and you're not losing anything, right? The seller prepaid that interest for you. The cool thing about that is if interest rates drop in the next, year, under, like, let's say what your year 2 is at 5.25, let's say they drop under that, you can refinance and you get to keep that credit that seller gave you. So let's say you still had $2,000 left of that credit, that goes towards a principal reduction when you go to refi. So a lot of people really love that loan product because right now, if you buy down a rate traditionally and then you refinance, you lose the money that you put to buy down. In this scenario, it goes towards an interest credit. So you don't lose it. You get to keep it, which is awesome when you go to refinance.
Quick question on that. What is the limit? Is there a limit for the amount of credit that a seller is allowed to give the buyer for the buy down credit?
Yeah, so typically you want to, loan programs are very differently a little bit in this, but they're pretty much all between 3.5%.
Okay.
So, which should get you on any price point, the buy down for the 2 years. And then there's also a 1-1 buy down, which is cheaper. Let's say the seller's like, I can't buy down interest for 2 years, right? I don't have that negotiation power, but you really want the house. You can get what's called a 1-1 and it's cheaper. So that means that for the first year, it's 1% lower. So if the rate was 6.25, it's going to be 5.25.
Mm-hmm.
And then for year 2, it's 5.25 again. And then year 3 through 30 is going to be 6.25. So it's basically just buying down 1 interest point for 2 years.
Gotcha.
So there's the 2-1 buy down and then the 1-1. And then lastly, you can just do 1 year, which is really cheap, right? Maybe a few $1,000s of interest that the seller pays, and it just buys down your interest 1% for 1 year. So depending on what the seller can do, that's a way that helps buyers be able to jump in there. And I'm seeing more seller concessions definitely being paid on behalf of buyers on contracts. So that's something that's helping everybody. And then the other one is that as of January this year, the restrictions have gotten a little bit better for getting loans. So traditionally, you needed more down payment, higher credit scores. And one thing that they're doing on conventional credit scores this year is it used to be you needed at least a 620 for conventional loan.
Mm-hmm.
And you still do need that if you're a single borrower. But let's say there's 2 of you on the loan. One of you has a 700 mid score and the other one has 650. They will average, or like, let's say 600 and 700. They will average those mid scores so that the loan is priced at a 650 credit score now. And the person who has under 600 can still qualify with the person. They can average those together. So that's bringing more buyers into the market. And that's on conventional 3% down. So that's a really affordable one. Obviously, you always have FHA, which goes down to 580 credit scores. And you can actually go a little lower on FHA on credit if you have some compensating factors, like maybe you have a higher paying job, length of history, right? So there's some compensating factors that your lender can help you with if your credit score is not great due to medical bills or other things. And FHA has a program to exclude like medical bills. They can't be counted against you on your credit. So there's a lot of little things. And that's why I always tell people, like, definitely talk to your mortgage professional if you're wanting to see where you qualify, because people will look at it online and they'll see, oh, I have to have a 2-year job history. I have to have a credit score of this, and I have to have down payment. Oh, I don't have it. But in reality, there's a lot of variances inside these programs that maybe we can use one compensating factor for another. So rarely do we get a loan that we can't make work. Another reason is at Castle and Cooke, we also do what's called non-QM loans. So we have like our own mortgage products, and we have investors that we can go out to that aren't traditional lenders. So we do a lot of self-employed loans, people that don't have a traditional W-2 or traditional paycheck, and we're averaging their income over the last 2 years. We do bank statement loans in case, you know, a lot of businesses need to write off things. I mean, you probably do that. I do that too when you're self-employed. So you write off a lot of things. So your taxes don't look great, right? And it's hard to qualify, but your bank statements for your business show you earning income, show you earning commissions. So we can do loans where we're just, where we're looking at your bank statements and calculating your income and using an average off of that. So there's loans for that too. So there's so many loan options. USDA is another one that I use a lot in Tuolumne County. That whole area is USDA, and USDA is 100% financing. So, and you don't have traditional mortgage insurance every month on it, like you do if you use CalHFA. CalHFA is also another like 100% financing program. It's an FHA product. USDA is rural housing. And it's one of my favorite programs if we can get the borrower in there, because it's 100% financing for pretty much all rural areas, and everywhere in that area where we grew up is basically rural. So it works out there.
So another idea that people, might, for people to get pre-qualify and for them to be able to get in a house would be assuming a loan from someone. That's not as common, but there might be some opportunities out there for a new buyer to be able to buy a home if someone had a certain type of loan and that rate is assumable.
Right.
Information on that?
Yeah, so I've actually just did my first one of these because they're coming back around. Obviously, we used to do them, 15 plus years ago. We would do more assumable loans, but we haven't needed to do those in a long time because rates have been so low. But FHA, VA, and the USDA all have assumable loans. So if the seller that you're looking at has an FHA loan on the home, or they have a VA loan or a USDA loan, and that's how they purchased the home, it may be possible for you to assume it. The benefit to that would be you're assuming their interest rate. And that's the huge benefit for people in those scenarios, is assuming interest rates that are lower than today's rates because you're taking over that loan. You still do have to use the traditional qualifying, like you need to have the, if it's FHA, the 3.5% down, VA and USDA can be up to 100%. And you have to have the minimum credit scores and the debt to income. So all of those things still have to be in place when you're assuming somebody's loan, but as long as you can qualify to assume, then technically you could take over their loan at that rate. The VA ones are a little bit harder because if you're a veteran, assuming another veteran's, great, that works perfectly. If you're a non-veteran trying to assume a veteran's loan, the veteran, if they do allow that to happen, has to give up their rights to another veteran loan because they gave it to you, basically. Okay. And so there are some buyers that are like, you know what, I just won't use a veteran loan next time. I need to move. I have to get out of town. That's one I just did recently. They had to move for a job and they don't want to give up their veterans benefits, but their house needs to sell. So they're going to give their veterans benefits to this non-veteran, basically, and then just get a traditional loan. So there are a lot of ways that can work. USDA, that can be anybody as well, just like FHA. And then conventional loans are not assumable. So
I had no idea that you can actually get the VA benefits for the rate if you're not a veteran. That's actually huge. So yeah. So what percentage of these VA loans or VA loans on FHA are assumable, you would think, from the previous rate?
In theory, 100% of them should be. They all should be assumable because they do allow that every once in a while. And this is where with the seller, you'd want them to contact their mortgage lender and just say, hey, is my loan assumable? I want to make sure there was no attachments to it, no riders to my deed, anything that would have made it so that we can't have it assumable. But I would say 99% of the time, they're going to be assumable. Okay. All of those.
That's really good to know, because that also is going to give another marketability layer to, people who want to sell their homes and they had an FHA or a VA or even a USDA, you said, correct? Loan?
Yeah. Mm-hmm. And they can make those assumable, which is helping both people out in this market. Yeah. The Buydown is helping out buyers with lower interest rates. And I would say just the 100% programs, if you are wanting to use one of the grant programs from California or for your area, you want to start looking into those well before you get into the house buying process. That's because those take time to get approved, to get into the system, and to know what you're shopping for. And sometimes people do the reverse of that, right? And they go out shopping and then they're like, oh, I need a grant program. I need to go to get 100%. And I'm like, oh, that takes a long time. Then you got 30 days. So if you are thinking about using one of those programs, or you're wanting to apply for a grant, let's say for nursing, medical, there's first responder grants. There are grants out there. And my husband's a police officer, so I do a lot of like first responder, police officer grants, and I love doing those, but they do take time. Like you have to apply for those ahead of time. So talk to your mortgage professional to get involved in those before you go out house hunting. So, you know.
Okay, so what about investors? What's kind of the going rate for investors out there who meet all the qualifications, say, you know, their and all of that stuff is good and credit score? What kind of rates are we looking at for them?
So investor rates in general are going to be about 2 points higher. And that I know isn't great news, but last year, about mid-year, the government put on all conventional loans, Fannie, Freddie, they put a price adjustment on second homes and investment homes in order to kind of curb that, right? To slow that down a little bit. And so that's why they are higher. You, of course, can buy down your own rate as an investor. So I have some investors that are like, well, I need the tax write-off. I'm going to buy down my rate right now permanently, throw some money at it at the beginning and just buy those 2 points back. You know, I mean, some investors are willing to do that. Some are like, I'm going to take whatever's out there because I think in a year it's going to be lower and I'll refinance. So obviously that's something to weigh out with the investment that you're purchasing, right? Are you getting a good enough deal on it that you can wait for the interest rate to drop? Or do you really need to buy that and you want to use the tax write-off, you know, for loan costs and things like that? So, but yeah, they are higher, definitely. And on investment properties, the minimum that you need is 15% down if you're doing an investment. And realistically, to get decent pricing, you want to be putting at least 20 to 25% down.
Okay.
Yeah, on investment properties. And then second homes, we do have programs that will let you get into a second home with 10% down. So that's great, but it of course will have the higher interest rate, about 2 points higher than whatever the market is for
PMI as well, private mortgage insurance.
Yep, you'll have PMI because it's under 20%. It's actually not bad. I've been able to find pretty good PMI insurance for second homes as long as you have good credit and you have other compensating factors, right? And one of the things we can do for investors to kind of improve their debt to income ratio, which helps with their rates, is we do what's called a rent survey on the home they're buying. And let's say I want to buy a rental. On my appraisal that I'm ordering, I'm going to order a rent survey. And then whatever the appraiser says that home would rent for, I can count 75% of that as income towards my new property. And then it doesn't make my debt to income ratio so terrible, right? It adds that money back into my income. So that's something that I'll usually always recommend. It's usually about anywhere between $200 and $400 more to have that on your appraisal, but it definitely will save you that in interest and your debt to income ratios by far.
That's great. Okay. All right. Well, I think that's all we have. Is there anything else you want to add as far as first-time home buyers? I think we cover all of that, being able to get a seller credit to buy down the mortgage rate for up to a couple of years. The fact that you can assume a loan if it's an FHA potentially, or VA, or even a USDA loan. Anything else we're leaving out for first-time home buyers that we should make them aware of?
No, other than if they are interested in any of those types of grants, you know, applying for those ahead of time, that would be something just to think about, because some people do want that. Another thing first-time home buyers, a lot of them that I see do is get a cosigner, right? If you're able to get a cosigner or a parent, even if they own a home, a lot of people think, well, my parents already own a home. That's okay. They can still cosign for you to get your home too. I have a lot of parents that do that for, you know, 20, 25-year-olds, 30-year-olds that are just kind of breaking into the market and they just need that extra help with credit, with income. So that's another way too.
And of course, would that take into consideration the parents or the co-signers' income and all of that, or just their credit?
It does take in their income. It depends on what I need from them. So if if we do need a little help with credit, then or income, then we could use both. I mean, I can use either or both. We can make that happen. And another program that's really cool, not necessarily always for first-time home buyers, but it's called the Family Opportunity Loan. And it's really for the reverse. So it's for people that are trying to buy homes for elderly parents or parents who can't afford homes right now, or parents that are older and don't have credit scores, or they're going to be moving in with their parent to take care of them. But you can use it for kids who are still in college. So I just did one where the students on there, but they don't really make any money because they're still in school, but the cost of renting is so high in the area that the parents wanted to help buy. And a lot of times parents aren't buying because the investment rates are so high, but this allows the parents to buy a home in that scenario where the child's still in school. Maybe they're working part-time, but they're still in college. They're allowed to buy at primary resident rates. So that really helps out a lot. Or they can buy their parents a home at primary resident rates, and they avoid the whole investment scenario altogether. And of course, can only put down 3 to 5%. So that's like a win-win.
Yes,
for
definitely. So even though interest rates are terrible, there's still opportunities, for people to make it happen. And,
there are. And I actually think in some ways the rates are higher, but you're also able to negotiate more with sellers. I mean, I'm seeing that. I don't know. You're seeing that, and you can almost buy back down to some of that sometimes and negotiate it.
How much would it take? I mean, what percentage would it take to buy down the interest rate permanently for someone, say, buying a $500,000 home with a 20% down, let's say, or just a minute. Let's just say if it was FHA and somebody had the extra cash to put to make it happen and permanently buy down the rate.
Yeah, with good credit and everything. To permanently buy it down. I mean, there is a cap as to where you can buy down when you're permanently buying down, because by law, lenders are not allowed to charge it's what's called a high cost mortgage. We can't just charge a crazy amount for a mortgage, right? We have to stay within guidelines. And at a certain point, there's always like this break where the government's like, this rate is so crazy, no one can pay for it, right? So it's not even on rate sheets when you look up rate sheets. But let's say you wanted to go down to the lowest possible one on a rate sheet. Usually that cap is going to be about 4 points or 4% of the loan. That's going to be about max. But if you want to just get at a reasonable rate that's really going to help you get into the lower fives, maybe about 2 points.
Okay.
2.5 points. So that's about 2%.
Okay, that's good.
So on 500,000, you're looking at about $10,000 in rate buy down permanently, which again, I see a lot of people asking sellers, like, hey, can I get 10,000 in a rate buy down? And then maybe they just buy it down permanently for that amount.
Okay, because that on the first scenario that we were talking about earlier, that only takes care for the first 2 years, right?
It does, but you're using it towards interest and you get to keep it. So some people's fear is, I'm going to take $10,000 that I could have gotten and I'm putting it, and it depends on how you feel about the market, right? But they're thinking, I'm putting that whole 10,000 down and maybe rates drop to 5.25 anyway next year, and I just spent 10 grand getting it. And in the buy down scenario where it's a 2-1 buy down, yes, you're throwing $10,000 prepaying your interest, so it's buying just your rate down for that interest amount. But if any time rates go lower, you get to refinance, keep that credit, and apply it towards a principal balance reduction. So some people are like, I know it's going to go down in a year, I feel confident, and I don't want to throw $10,000 nowhere. At least this way I get to keep what I don't use.
I see. Okay,
But you could end up in theory, right, with 6.25 if rates never went down.
Exactly.
So,
yeah.
So that's kind of a comfort level, and I try to walk people through that, right? Like, which of these do you feel best about? If the worst case scenario, getting stuck at 6.25 is okay with you,
right?
Because you can see all the payments and we talk about them, then great. This is a great way because you might get to keep a lot of your money.
Yeah.
Or do you want to just buy it all the way down, and if rates go down, you lost it? I mean, some people just feel more comfort in that too.
Yeah, just knowing that your rate's going to be this much, and just thinking of it, well, that's just part of the purchase price, you know, kind of
Yeah,
thing.
exactly. And it's
But,
exactly.
you know,
So,
there's a gamble. No matter what you do, there's going to be a gamble there. So,
yeah.
right.
Yep.
Well, I think
Yeah.
that's all we have today, Jodie. Thank you for
Awesome.
and we definitely need to keep in touch, and
Yeah.
another update here in a few months. That'll be great.
Yeah, definitely. And I know like a lot of the programs are rolling out new rules and new laws to make it easier for people. So maybe next time we could catch up on some of those new rules and see what they are as they come out.
That would be great. Well, thank you
Sure.
so much. I hope everyone found these some tips out of here that can help them. And we'll see you next time, Jodie. Thank you.
All right. Thanks. Bye.
Bye-bye.